In today's episode, I'll talk about two interesting stories. In the first one, I'll talk about how India's biggest private oil refiners are now abandoning global markets so that they can fight for customers at your local petrol pump. And in the second story of the day, I'll talk about how the RBI is changing India's gold loan industry with new rules that could change how millions of us borrow against our jewelry. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy for all of us to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Wednesday, the 11th of June. See, India's oil refining story is very quietly undergoing a very big shift right now. According to a recent Reuters report, companies like Reliance Industries and Nayara Energy, which have spent decades in shipping refined petroleum products to customers in Europe, Asia, and the Americas, are now suddenly turning their focus back home. Now, they are competing aggressively for Indian consumers at local fuel pumps. And that small change tells us something that's very important about how the global energy landscape is evolving and why India's domestic market suddenly looks more attractive than it ever did before. But to understand what's exactly happening, let's first step back and start with how India's oil refining industry even works in the first place. See, oil refiners take crude oil, which is a thick black liquid pumped from underground, and then they process it through massive facilities so that they can create useful products like petrol, diesel, and jet fuel as well. Now, you can almost think of it like highly sophisticated cooking processes where different temperatures and techniques yield different end products. Now, in India, this industry has always been split into two camps. On one side, you have the government-owned giants like Indian Oil Corporation, Bharat Petroleum, and Hindustan Petroleum. Now, these companies have traditionally focused on serving Indian consumers, running most of the fuel stations that you see across the entire country. They basically control more than 87% of India's roughly 64,600 petrol pumps. But on the other side, there are private players like Reliance Industries and Nayara Energy. Now, when these companies entered the refining business, they faced a small little problem. The domestic market of India was already dominated by state-run companies. Plus, while the government officially deregulated fuel prices many years ago, it still effectively controls them through taxation in some way or the other. Basically, more than half of what you pay at the pump is actually taxes, and the government very frequently adjusts these to manage inflation or revenue requirements. And this makes the domestic market very complicated and unpredictable as well. So these private refiners have built a different strategy to navigate this. See, instead of serving the Indian consumers, they decided they would be better off serving the rest of the world. Reliance, for example, constructed the massive Jamnagar complex in Gujarat, which became the world's largest single-site refinery and was capable of processing 1.4 million barrels of crude oil every single day. Nayara, on the other hand, built its Vadinar facility with a 20 million tons annual capacity. Now, mind you, these were not just regular refineries, they were in many ways export machines of sorts that were designed to ship fuel products globally. And the numbers show just how export focused they were. In FY 22-23, Reliance exported 36.1 million tons of petroleum products, which is about 80% of India's total fuel exports. And even as India's exports grew to about 63 million tons in the following year, Reliance still accounted for about 60%. Nayara, on the other hand, was exporting roughly 40% of everything that it produced. Now, for years, this model worked brilliantly for them. International markets offered better prices and fewer regulatory complications came up. But then came COVID-19 and everything changed. The pandemic did not just disrupt supply chains temporarily, it fundamentally altered global energy consumption patterns. Now, when the world reopened, refiners initially experienced a big boom. Years of underinvestment in refining capacity met surging post-lockdown demand, which created what industry experts call refining supercycle. Now, throughout 2022, if you ran an oil refinery hypothetically, you were making exceptional profits. But this boom was built on weak foundations, and that was a problem. See, after the initial surge, global oil demand began to plateau and even decline in some important markets. China, for example, which had driven global fuel demand growth for many decades, saw consumption peak and then fall slightly in 2024 as electric vehicles gained ground and economic growth slowed down. Now, the International Energy Agency predicts that global oil demand growth will slow from 990,000 barrels per day in early 2025 to just about 650,000 barrels per day for the rest rest of the year. Anyway, meanwhile, new supply kept flooding the market. Non-OPEC countries like the US, Brazil, Canada, and Guyana ramped up their production. New refineries came online globally, and suddenly there was too much refined fuel that was chasing very little demand in comparison. And the result, of course, was brutal for exporters. The Singapore complex refining margin, which is a very important profitability indicator for Asian refiners, plunged to just $1.6 per barrel in September 2024, and mind you, that was the lowest figure since 2020. European diesel margins also crashed from peaks of $30 to $40 per barrel to just around $13 per barrel. But while global markets were struggling, India was actually experiencing exactly the opposite. Our diesel consumption hit a record 91.4 million tons in 2024-2025, up from 85.9 million tons just 2 years earlier. Petrol consumption also went up to 40 million tons from 35 million tons. And the reason for all of this is pretty straightforward, which is India is still in the early stage of motorization. See, with only 22 cars for every 1,000 people in our country compared to 821 in the US, there is enormous room for growth. To give you some more context, India's car industry just had the best year ever in 2024, where they sold 4.3 million vehicles. And more than half of Indian households now own a two-wheeler. And to add to this opportunity was an unexpected advantage as well: heavily discounted Russian crude oil. See, before 2022, Russia was a minor supplier to India and was ranking about 17th with just about 1% of imports. But when Western countries started hitting Russia with sanctions after the Ukraine conflict, Russia desperately needed new buyers. Now, Russian crude oil started trading at massive discounts, as much as $25 to $30 per barrel below Brent crude prices in early 2023. Now, Indian refiners, particularly Reliance and Nayara, seized this opportunity very well. By 2023, Russia had become India's largest crude supplier, providing over 30% of our total imports. And today, Russia routinely supplies 35 to 40% of India's monthly crude needs. Now, while discounts have been narrowed to around $2.25 per barrel below Brent by mid-2025, they still provide a very important and significant cost advantage. Analysts estimate that Reliance's refining margin is about $2 per barrel above the Singapore benchmark, and it's largely due to cheaper Russian crude. Now, interestingly, while many countries would not buy Russian crude directly due to sanctions, they were happy to import refined products from India. And that is probably because once it was processed in Indian refineries, the diesel or petrol was no longer tagged as Russian oil, which basically made it acceptable to global buyers. In some sense, India essentially plugged a Russia-sized hole in global oil markets, and that, mind you, is a very big deal. So then, with strong domestic demand, cost advantages from Russian crude, and weakening export markets, Reliance and Nayara made a very important decision. They decided to pivot towards the Indian market. Now, this shift has been very dramatic. In FY 2024-2025, these two companies together captured 11.5% of India's diesel sales and 9.2% of gasoline sales. Now, to give you context, just 2 years earlier, their combined shares were only at 5.2% for diesel and 6.7% for gasoline. And if you're wondering how they've done this, they are achieving this through aggressive retail expansion. See, Reliance's GeoBP joint venture now operates over 1,950 fuel stations, and they plan to invest 10 billion Indian rupees annually so that they can add even more. Nayara, on the other hand, has built India's largest private fuel retail network with over 6,500 outlets, and they're adding 400 new stations in 2025 alone. But beyond just building stations, they are also competing on price. GeoBP, for example, undercuts state retailers by 1 rupee per litre, and Nayara offers even steeper discounts of 2 to 3 rupees per litre. Now, for commercial buyers like trucking companies purchasing fuel in bulk, these savings could add up very significantly. And the data also confirms that this is not just growth, it is a genuine strategic shift. In April 2025, India's diesel exports plunged to just 1.15 million tons, which is the lowest monthly volume since 2012. Now, Reliance, which typically drives a large chunk of these exports, saw its diesel shipments drop to around 0.8 million tons as it diverted more fuel to domestic buyers. Now, while May's numbers showed some level of recovery, the company's own earnings call revealed the new priority. Reliance's executives have repeatedly emphasized their focus on domestic placement. They spoke about China's weakening demand due to rising EV penetration, high inventory levels in Singapore, and how India's gasoline demand grew 6%. They also explained that their strategy was to maximize value by processing the right crude route types and pushing more volumes domestically. And this strategic pivot reflects a very fundamental shift in global energy markets. The era of ever-growing global oil demand appears to be ending right now, at least in the developed markets. In many ways, electric vehicles, renewable energy, and efficiency improvements are finally beginning to reduce oil consumption. The real growth is now concentrated in emerging markets like India, where hundreds of millions of people are still joining the middle class and buying their first vehicles. Now, for India's private refiners, selling domestically suddenly makes more sense than chasing uncertain export markets. They save on freight costs and export duties, while they can also capture better margins through their own retail networks. So, in a world where oil demand growth is increasingly scarce, the 1.4 billion person Indian market looks like the best opportunity available right now. So, what we are witnessing right now, in some sense, goes beyond just a small business strategy change. It tells us how global trade patterns are evolving, and companies that built their fortunes on globalization and export markets are increasingly looking homeward now. For Indian consumers, this means more competition at the petrol pump and potentially better prices as well. And for the global oil market, it is another sign that the old patterns of trade and consumption are now breaking down and are being replaced by something that is more regional and complicated. That brings me to the end of the first story of the day. Let's now move on and talk about the second story. Gold has always had a very special place in Indian households. It's not just wealth that is stored away in lockers, it's usually the first line of defense of sorts when financial emergencies come into the picture. For example, when a medical bill arrives unexpectedly, or when school fees are due, or maybe when a small business needs quick capital, millions of Indians turn towards their family jewelry. They basically walk into a bank or finance company, they pledge their gold bangles or chains and walk out with cash. Now, this very simple transaction, repeated countless times across the country every single day, forms the very backbone of India's gold loan industry. Now, the Reserve Bank of India has recently decided to completely change how this entire system works. On the 3rd of June 2025, the central bank unveiled what it is calling Lending Against Gold and Silver Collateral Directions 2025. Now, essentially, this is a new rule book that every bank, every non-banking financial company, and every cooperative bank in the country will need to follow starting April 1st, 2026. Now, mind you, they are not minor changes. They are comprehensive changes that will completely change how gold loans are given, processed, and recovered across our entire country. But to understand why this even matters in the first place, what we all need to understand is that gold loans in India have traditionally operated in a gray area between formal rules and informal practices. Different lenders have basically followed different standards. Some valued gold properly, others made rough estimates. Some stored pledged jewelry securely, others were more casual about it. Some returned gold promptly after loan repayment, while the others actually dragged their feet a lot more. Now, last September, the RBI highlighted several concerning practices, from lenders outsourcing critical checks to third parties to even making suspiciously large cash disbursements, which raised questions about whether these loans were being misused for purposes beyond household needs. Now, the new rules that have just been introduced attempt to bring order to this particular chaos. They create for the first time a uniform set of standards that apply to everybody in the gold loan business, right from the largest banks to the smallest cooperative societies. So let's start with the most basic question to understand things in detail. What can you actually pledge for a loan now? See, the RBI has drawn a very crystal clear boundary. You can borrow against gold or silver that is in the form of jewelry, ornaments, or coins. So your wedding necklace, those silver vessels which were passed down through your older generations, and the gold coins that you bought during Dhanteras maybe, all of these qualify as acceptable collateral. But anything that looks like it belongs to a bullion vault is now strictly off limits. You cannot pledge raw gold bars or silver slabs, which is what industry calls primary gold in bullion. And very similarly, all those modern financial products which are linked to gold, like gold ETFs, gold mutual fund units, or even sovereign gold bonds, cannot be used as collateral either. So with all of this, the RBI is essentially saying that gold loans should be about actual physical gold that households possess, not investment products or raw materials that traders might actually pile. But mind you, even with the right kind of gold, there are still limits to how much you can pledge. For gold ornaments, for example, no one single borrower can pledge more than 1 kg, which anyway, to be fair, is quite a lot of jewelry. For silver ornaments, on the other hand, the cap is 10 kilograms. But when it comes to coins, the limits are much tighter. You can only pledge up to 50 grams worth of gold coins or 500 grams of silver coins. Now, this distinction makes sense when you think about it. Coins are easier to fake, easier to trade in bulk, and more likely to be used for purposes other than genuine household financial needs. And these gaps also reveal what the RBI is trying to achieve, which is keeping gold loans focused on their original purpose of helping households in need rather than actually becoming a backdoor for large-scale financial operations or maybe even money laundering. Now, for everyday borrowers, these new rules can bring several very important changes. Perhaps the most important of everything is how much money you can borrow against your gold. See, under the new rules, if you're taking a small loan for personal use, which is what the RBI calls a consumption loan, you can now borrow up to 85% of your gold's value, provided the loan amount is under 2.5 lakh rupees. So, in simple terms, if your gold jewelry is, let's say, worth 1 lakh rupees, you can now get 85,000 rupees as a loan against it instead of the 75,000 rupees you might have gotten before under the informal norms most lenders followed. But there is also a sliding scale here. See, as your loan amount increases, the percentage that you can borrow also starts to decrease. For loans between 2.5 to 5 lakh rupees, you can borrow 80% of the gold's value. But for anything above 5 lakh rupees, it actually drops to 75%. Now, this structure clearly favors smaller borrowers who need emergency funds over larger borrowers who might actually be using gold loans for business or investment purposes. And the paperwork requirements have also been very thoughtfully restructured. For loans up to 2.5 lakh rupees, lenders cannot demand detailed income proof or credit assessments. Your gold itself is considered sufficient security. So if somebody is pledging a piece of jewelry for, let's say, 50,000 rupees to cover a hospital bill or maybe a school fees, they will not really need to run around gathering salary slips and tax returns. This process should be quick and simple. But if you're taking a larger loan, let's say above 2.5 lakh rupees, you can expect more scrutiny. Lenders will basically assess your repayment capacity just like how they would for any other loan so that they can ensure you are not over borrowing just because you have a lot of gold holdings. Now, one particularly important change concerns how these loans are structured and renewed. See, most gold loans today are bullet loans, which means you can borrow the money, pay nothing for many months, and then repay everything all at once, including the interest amount. Now, the RBI is still allowing the structure, but with crucial new restrictions. Such loans can now only have a maximum term of 12 months. You can renew or roll over the loan, but there is a key change. You must first pay all the accumulated interest from the previous term. Now, I know this might sound like a bit of a technical detail to all of you, but the thing is that it addresses a very serious problem. See, earlier, borrowers could keep rolling over their loans indefinitely almost, while interest kept piling up silently in the background. And after a few years, they would face a massive bill that they could not possibly even repay, often losing the gold in the process. Now, this new rule forces borrowers to at least keep clearing interest regularly, which prevents debt from sort of snowballing out of their control. The consumer protection measures in these new rules are perhaps the most comprehensive that has ever been seen in India's gold loan sector. Every stage of the transaction now has clear guidelines designed to protect borrowers from unfair practices. Let's take valuation for instance. See, lenders now must have standardized processes for weighing gold and testing its purity across all branches. No more arbitrary assessments or different standards at different locations. And you as a borrower have the right to be present when your gold is being tested. If a bangle is said to be, say, 22 carat, it should be valued at 22 carat rates, not anything less whatsoever. And if, for example, the lender makes any sort of deductions, let's say, for example, for stones embedded in the jewelry, they must give you a detailed certificate explaining exactly how they have calculated the value. Basically, the days of opaque, trust me valuations are now over. Storage and security also receive similar attention. Your gold can only be handled by the lender's own employees, no outsourcing to third parties who might be careless or unaccountable for it. It must be kept in branches with proper vaults and security systems. Now, many large NBFCs already maintain such standards, but now it is mandatory for everybody. Basically, if a branch does not have adequate security infrastructure, it simply cannot offer gold loans. But perhaps most importantly, there are now strict timelines and penalties for returning gold after loan repayment. See, lenders must return your jewelry within 7 working days of full repayment, ideally on the same day. And if they delay without a valid reason, they must pay you 5,000 rupees for every single day of delay. Now, this provision addresses a very common complaint where lenders would hold on to gold even after they received payment, citing various procedural delays, while borrowers were actually worried about their precious family jewels. Now, for gold loan companies like, let's say, Muthoot Finance and Manappuram Finance, these new rules bring both opportunities and a lot of challenges. The higher loan-to-value ratios for smaller loans could expand their market, which could allow them to serve more consumers consumers with better terms. And the ability to offer top-up loans, which is essentially extra money on the same pledged gold within the overall LTV limit, provides more flexibility in product design. And when these rules were announced, by the way, shares of major gold loan NBFCs actually rose, which suggests that the markets also see them as beneficial overall. But that said, compliance will not at all be cheap or easy. The companies will need to ensure every branch follows identical valuation procedures. They'll need to upgrade security infrastructure wherever necessary. Staff will need extensive training on new processes, and the auction process for loans that go bad will become more complex as well, because companies must now give proper notices, advertise in newspapers, and also ensure transparency. Their own related parties are barred from bidding in these auctions, which basically eliminates some of the informal channels that they might have used earlier to quietly dispose of unclaimed gold. Now, for established players, many of these requirements simply formalize what they were already doing. Muthoot Finance, for instance, has for a very long time highlighted this robust safe room infrastructure and transparent processes. But for smaller lenders or new entrants for that matter, the compliance burden could be very, very substantial. In a way, these rules might actually strengthen the position of large organized players who can afford the infrastructure and processes required, creating a competitive moat that others will sort of struggle to cross. But all that said and done, while this is great, the real test of this will come in implementation. See, rules are only as good as their enforcement is, and the RBI will really need to ensure that its inspectors actually verify compliance on the ground and not just check paperwork. The gold loan industry will need to also adapt to its operations significantly, from the largest corporate offices to the smallest rural branches. And borrowers will also need to understand their new rights and insist on them when dealing with lenders. But if all of this is actually implemented well, these regulations could really transform gold loans from a necessary evil which desperate families turn into in terms of crisis to a legitimate, transparent financial product that helps millions of people leverage their most precious assets safely and also fairly. That brings me to the end of the two stories of the day. With that, let's move on to the final section and talk about the quick news headlines. First, fast fashion giants Shein and Reliance Retail plan to scale up their Indian supplier base from 150 to 1,000 within a year, with ambitions to begin exporting India-made Shein branded apparel to the US and UK in the next 6 to 12 months. Second, India's sugar production is projected to rise to 35 million metric tons in the 2025-26 season, marking a near 20% increase over the previous year, according to the National Federation of Cooperative Sugar Factories. This expected recovery follows 2 consecutive years of drought that saw net sugar output fall below domestic consumption for the first time in 8 years. Third and the final one for the day, Tata Power's solar manufacturing arm, TP Solar, has achieved a cumulative production of 4,049 megawatts of solar modules and 1,441 megawatts of solar cells at its Tamil Nadu facility as of May 31st, 2025. The plant, which is built to meet domestic content requirement or DCR norms, is equipped with advanced manufacturing lines for mono PERC and TOPCon technologies. That's all the news and stories I have for you today. I hope you enjoyed this episode. This is your host Anurag Bansal signing off. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.